Rare earth stocks jumped after China tightened export restrictions and Trump threatened new tariffs, sparking renewed trade war fears. This triggered a market sell-off, with the S&P 500 and Nasdaq suffering their worst drop since April 10th. Treasury yields declined, gold prices climbed, and defensive sectors outperformed as investors shifted towards safer assets. Microchip and copper stocks were hit the hardest. Chipmakers dropped on concerns that rare earth limits could disrupt semiconductor supply chains, while copper prices fell as traders anticipated weaker demand from China and the U.S. The U.S. has labeled rare earths as critical minerals because they're essential for national security and face significant supply risks. Their unique magnetic properties make them vital for industries like electric vehicles and defense systems. As part of its Security and Resiliency Initiative, JPMorgan Chase announced a $10 billion investment in sectors crucial to national security. Jamie Dimon emphasized that the U.S. has grown too dependent on unreliable sources for critical minerals and manufacturing, stressing the need for faster action, more investment, and the removal of barriers such as excessive regulations, bureaucratic delays, political gridlock, and skill gaps in the education system. With China supplying about 90% of rare earths, efforts to reduce import dependence have boosted rare earth stocks. MP Materials and Australia's Lynas Rare Earths have led the rally. MP runs the only large-scale U.S. rare earth mine but still relies on China for processing, and its stock jumped after the Pentagon became its largest shareholder. Lynas, the biggest producer outside China, has U.S. Defense Department backing and could benefit if Australia sets a price floor. Other players like USA Rare Earth, Niocorp, and Energy Fuels also saw strong gains. Despite momentum from tight supply, these companies struggle with profitability and high valuations. MP has negative operating income and trades far above sector revenue averages, while Lynas posts deep cash flow losses and a significant earnings premium. Rare earths aren't the only critical minerals in demand. Copper, nickel, cobalt, lithium, and graphite are also expected to see strong growth over the next 10 to 15 years as countries push for clean tech and net zero emissions. Copper faces structural supply challenges from declining ore grades, fewer discoveries, long project lead times, and underinvestment beyond just geopolitical risks. A major copper supply deficit could emerge within the next decade as electrification drives demand, according to IEA forecasts. While rare earth stocks remain highly valued, beaten-down copper and chip stocks now offer potential buy-the-dip opportunities, especially after last week's market sell-off. Hudbay Minerals, a copper producer with assets in Peru, Canada, and the U.S., saw its shares rise in August after Mitsubishi bought a 30% stake in its Copper World project in Arizona, bringing an initial $600 million cash infusion. Copper World is fully permitted and could boost Hudbay's annual copper output from 133,000 tons to 250,000 tons, while the company maintains a diverse portfolio including silver, gold, zinc, and molybdenum. Hudbay has outperformed its peers this year, driven by strong copper production and cash flow. It reaffirmed 2025 production guidance of 170,000 to 149,000 tons of copper and 247,000 to 308,000 ounces of gold, and lowered cash costs to $65 to $85 per pound. With a 46% EBITDA margin and strong returns, Hudbay demonstrates exceptional profitability in the materials sector. Hudbay's earnings and cash flow have surged over the past year thanks to higher copper and gold prices, strong cost margins, and geographic diversification, earning it an A growth grade with solid growth forecasts. In the last 3 months, analysts issued 12 upward earnings revisions versus 1 downward, projecting EPS growth of over 81.8% in fiscal year 25 and revenue rising 13.7% to $230 billion. While its low dividend yield weighs on its valuation grade, Hudbay's PEG FWD of 0.32 reflects a nearly 77% discount to the sector, showing stronger fundamentals than rare earth peers and readiness to rebound. Micron, the top-rated semiconductor stock, has gained about 80% in the past year and is a top tech pick for Q4. Its leading position in low-power DRAM for data centers drives strong revenue, earnings, and long-term growth. After the recent chip sell-off, Micron's valuation looks attractive at 10.9 times earnings versus the sector's 24.59 times, with a PEG FWD of 0.17, offering a significant discount. Micron posted record Q4 and full-year revenue fueled by booming AI data center demand, which boosted revenue, EBITDA, EPS, and cash flow, while AI tools improved productivity and margins. CEO Sanjay Mehrotra highlighted strong positions in HBM, 1-gamma DRAM, and G9 NAND, tight DRAM supply, and disciplined execution as drivers of robust profitability. Fiscal Q1 guidance points to new revenue and EPS records. Long-term growth prospects are strong, with EPS projected to rise 65% and fiscal year 26 earnings expected to double, alongside 43% revenue growth to $53.66 billion. Micron's EBITDA and net income margins outperform the sector, earning it an A-plus profitability grade. With a dominant market position and exposure to megatrends, Micron remains a strong buy despite recent market pullbacks. First Quantum Minerals, a Canadian miner with operations in Zambia, Turkey, and Mauritania, has seen strong momentum, rising about 30% in the past 3 months. In Q2 2025, roughly 80% of revenue came from copper, with nickel and gold making up the rest. The company targets 380,000 to 440,000 tons of copper in fiscal year 25, mostly from Zambian mines, and sees long-term growth driven by major South American projects and African expansions. In Argentina, Taca Taca could produce up to 275,000 tons of copper annually at low costs over a 32-year mine life, pending environmental review. In Peru, La Granja, the largest undeveloped copper resource in the world, has an inferred 4.32 billion tons at 0.51% copper, with First Quantum holding a 55% stake and operating the project. Wall Street analysts expect First Quantum's revenue to jump to $9.19 billion in fiscal year 27 from $5.17 billion in fiscal year 25. Although revenue fell 10% last year, the company delivered strong operating profit and cash flow growth, with forward EPS at 25%. EBITDA margin sits at 37%, and a capex to sales ratio of 25% shows solid reinvestment to drive growth. Despite trading at a sector premium, First Quantum's strong margins, momentum, and earnings potential make it a strong buy, rounding out our list of stocks well-positioned to rebound from trade war-driven market sell-offs. Rare earth stocks surged after China tightened export controls and Trump threatened new tariffs. With China producing nearly 90% of the world's supply, countries are racing to reduce import dependence. While rare earth stocks benefit from constrained supply, many face high valuations, weak profitability, and poor cash flow. Critical mineral stocks with stronger fundamentals may gain from these structural tailwinds. Micron, a leading chipmaker, fell amid concerns about supply chain impacts, but remains attractive due to its dominant position in the semiconductor data center market, presenting a clear buy-the-dip opportunity. Thanks for watching. See you in the next one.